Timing the market sounds like the smartest way to invest. Buy low, sell high, and watch your money grow. But in reality, almost nobody can do it successfully, not even the professionals. Markets move fast, emotions get in the way, and the biggest gains often happen when investors least expect it. We'll explore why predicting market highs and lows almost always backfires, how missing just a few good days can destroy your returns, and why a long-term consistent strategy outperforms timing every single time. Today, we will talk about why timing the market never works, explained simply. So before we start, make sure to hit the like button and subscribe to my channel. Timing the market sounds easy, but reality is the opposite. The biggest illusion about timing the market is the belief that it's obvious when prices will go up or down. In hindsight, everything looks clear. I should have bought then, or I should have sold before that drop. But hindsight is a liar. During real-life market swings, nobody knows what's coming next because market prices are constantly absorbing new information. News events, earnings reports, political changes, investor emotion, inflation numbers, interest rate announcements, global conflicts, and even random unexpected events. These cannot be predicted consistently, making timing the market more a gamble than a strategy. Markets move fast, often too fast for you to react. Long-term market charts show slow, smooth growth, but real-time movements happen in seconds. The biggest market gains or losses don't unfold over weeks. They happen in hours, minutes, and sometimes seconds. By the time news reaches the public, markets have already reacted. This means the average investor is always several steps behind. If you wait for the right moment, the markets usually move without you. This speed alone makes successful timing nearly impossible. Missing the best market days destroys your returns. One of the clearest reasons timing the market fails is simple math. If you miss even a few of the market's best days, your long-term returns collapse. These best days usually occur during market chaos, exactly when fearful investors have sold and stayed out. Research shows that being out of the market for just the 10 best days over a 20-year period can cut your returns in half. Missing the best 20 days can eliminate almost all gains. The problem is you cannot predict when these days will happen. They often occur right after the worst days. Market timing almost guarantees you'll miss them. The market's biggest gains often happen when fear is highest. The market is counterintuitive. The largest recoveries tend to happen immediately after the largest drops. When panic is at its peak and people have sold their investments out of fear, the market often rebounds sharply within days. This is why investors who wait for things to calm down usually miss the recovery. Emotions tell people to sell during fear and buy during excitement, but the market rewards the opposite. Trying to time the market based on emotions leads to buying high and selling low, exactly the opposite of what builds wealth. Nobody can predict the future, not even experts. Financial analysts, institutions, hedge funds, and Wall Street professionals spend billions on data, algorithms, and research, and even they cannot consistently predict short-term market moves. Studies show that over 90% of actively managed funds fail to beat simple index funds over long periods. If the most skilled investors in the world cannot do it reliably, what chance does the average person have? Predicting short-term market moves is like predicting the weather months in advance. You can guess, but you can't know. The market reacts to emotion, not logic. Many beginners believe market movement is purely logical, but in reality, markets are heavily influenced by psychology. Fear, greed, herd behavior, rumors, and emotional reactions drive prices far more often than rational analysis. Since human emotion cannot be predicted mathematically, price movements cannot be predicted either. This unpredictability is why markets spike when people expect them to drop and fall when people expect them to rise. Logic fails because markets don't move on logic alone. They move on behavior. Long-term investing works because it ignores short-term noise. Instead of trying to guess where the market will go next week or next month, long-term investing embraces the fact that markets grow over decades despite short-term volatility. Historically, markets consistently rise over the long run because of economic growth, innovation, productivity improvements, and inflation. When you stay invested, you ride out temporary declines and benefit from long-term expansion. This approach eliminates the need to predict short-term movements and instead focuses on what is predictable, long-term growth. Dollar cost averaging beats market timing over time. Dollar cost averaging, DCA, is one of the most reliable and stress-free investing strategies because it removes emotion, guesswork, and the pressure to predict the market. Instead of trying to time investments perfectly, which even professionals struggle to do, DCA allows you to invest a fixed amount at regular intervals, weekly, monthly, or quarterly, regardless of whether the market is up or down. When markets drop, your fixed investment amount buys more shares. When markets rise, it buys fewer shares. This automatically lowers your average purchase cost over time, without you doing any extra work. Dollar cost averaging eliminates emotional mistakes like panic selling during a downturn or chasing hype during a rally. By sticking to a schedule, you invest calmly, consistently, and intelligently, regardless of market noise. Trying to invest a lump sum at the perfect time often leads to hesitation, fear, or regret. But with DCA, you don't need perfect timing. You just need consistency. Over time, the strategy smooths out market volatility and builds wealth steadily. You can set up automatic transfers to your investment account, making wealth building effortless. History shows that long-term investors who use DCA consistently tend to outperform those who jump in and out trying to guess the best times. Market timing is stressful and drains mental energy. Trying to guess the market creates constant anxiety. Should I buy now? Should I wait for a dip? Should I sell before things get worse? What if I miss the rally? This cycle of fear and doubt is exhausting. Long-term investing, on the other hand, reduces stress because your success no longer depends on perfect timing. It depends on consistency. You stop worrying about daily market swings and instead focus on predictable long-term wealth building. Timing the market makes you reactive, not strategic. Trying to time the market turns investing into an emotional guessing game. People who constantly jump in and out of investments based on news, rumors, social media trends, or fear end up reacting, not planning. This type of investing is often impulsive, stressful, and driven by short-term noise instead of long-term vision. Reactive investors respond to headlines, expert predictions, or sudden price drops, believing they can outsmart the market. But reacting is always slower and less accurate than having a solid strategy. By the time most people react to news, the market has already priced in that information. As a result, reactive investors often buy high when markets are hyped and sell low when fear takes over, the exact opposite of smart investing. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.